Nvidia releases financial report, US-India negotiation black swan event, and the 15% pullback risk fully explained. Let me ask you a question. Why have the US stock market indices hit new highs, but your account is still stagnant or even falling? Today, we will dive deep into the analysis. The latest financial report of Nvidia. Let's see if there are any hidden risks behind this impressive performance. Meanwhile, the Black Swan event in the US-India negotiations has also triggered sharp market fluctuations, potentially bringing a 15% pullback risk. Is it an opportunity or a hidden risk? Let's quickly uncover it together. Hello everyone, I'm Chinking, a stock expert with 8 years of investment experience in the US stock market. Before we start the video, please take a moment to hit the like button and subscribe to my channel. Your support is the motivation for me to keep providing in-depth analysis. Today, all eyes are on Nvidia's performance, and the overall performance of the US stock market hasn't shown much fluctuation. There's really not much worth discussing. However, there's one major event today, and that is the news about tariffs. The United States officially imposes a 50% tariff on India. Trump did not back down this time, and India has become the country with the highest tariff rate imposed by the United States. This ultra-high tariff is expected to put tremendous pressure on India's exports, especially in some key sectors. However, Indian Prime Minister Modi has taken a firm stance, stating that the government will strongly support India's small businesses and farmers. No matter the pressure, the Indian government will strengthen its own capacity to resist this measure. Some believe this could trigger inflationary pressures in the US, but in reality, it won't. The main goods the U.S. imports from India include pharmaceuticals, communications, equipment, and clothing. Despite this, Trump has exempted certain industries, particularly pharmaceuticals and electronics, because the U.S. temporarily cannot wean itself off its dependence on Indian products, especially given Apple's large-scale investment in new factories in India. India has stated it will take retaliatory measures against the U.S. tariffs. But the market seems unconcerned, because if action is taken, Trump might impose even stricter measures. The tariff changes not only affect India but could also impact major U.S. corporations. About 2/3 of large U.S. enterprises have operations in India, and high tariffs could undermine the U.S. outsourcing policy, affect plans to shift factories from China to India, and weaken India's position in the global supply chain. Additionally, the U.S. has canceled the planned 6th round of trade talks in New Delhi, marking an escalation in trade tensions. India may respond by providing fiscal subsidies to exporters or developing new markets. However, domestic opinion in India opposes the U.S. tariff hikes, arguing that the U.S. is lenient on China when buying Russian oil but applies a double standard to India. U.S. Treasury Secretary Benson responded that China primarily uses its oil for domestic consumption, while India resells it for profit, calling India a middleman. India's tough stance has not effectively changed the situation, instead revealing its vulnerabilities in the global economy. Modi's government hopes to negotiate for lower tariffs, particularly compared to countries like Vietnam, Bangladesh, and China. But the current U.S. policy has not offered sufficient concessions. This is closely related to India's push for the Made in India strategy, which aims to attract more industrial transfer and drive economic rise. Modi had hoped to secure us leniency on tariffs through certain concessions, but Trump did not bite. The U.S. is facing huge debt and relies on external supplies to maintain its economy, while India boasts that its GDP has surpassed Japan and is rapidly closing in on Germany, becoming the world's third largest economy. Such high-profile boasting is unlikely to go unnoticed by the U.S. Trump and Modi clearly have different objectives. For instance, Trump wants Apple to avoid moving more factories to India, while Modi hopes to attract foreign investment to boost India's manufacturing sector. India aims for a small free trade agreement, but Trump is not very interested. There is a significant difference between India's negotiation approach and Trump's deal-making style. The key issues moving forward include, first, the agricultural issue. Modi cannot make concessions here because agriculture is crucial to domestic political stability, especially in Punjab, where farmer dissatisfaction could lead to political unrest. Second, the energy and oil issue. Modi's government is unwilling to compromise. India's economy is heavily affected by monsoons and fluctuations in international oil prices, and it has yet to escape this dilemma. Additionally, as one of the world's largest oil importers, India has offset its trade deficit by reselling Russian oil, earning billions of dollars each year. Despite the large trade deficit, India has maintained economic stability through remittances and a surplus in IT services. India's foreign exchange earnings are of great importance to the global economy. Every year, India injects massive amounts of capital into its economy through outsourcing industries and telecom scams, which generate as much as $30 billion in foreign exchange earnings. However, India's foreign exchange revenue issue is much more complicated than it appears. Although these earnings make up a significant portion of India's foreign exchange income, they are still far from sufficient to meet India's annual foreign exchange requirement of $160 billion. To bridge this gap, India has been forced to rely heavily on external borrowing to meet its foreign exchange needs, resulting in India's foreign debt reaching $620 billion. That this massive debt figure is a result of India's years of status quo policies. To prevent further expansion of foreign debt, Indian authorities have resorted to extreme measures with foreign enterprises. According to some observers, even international giants cannot operate smoothly in India. In India's economic structure, foreign enterprises are key to acquiring foreign exchange, but their profits are often eroded by India's taxation and other forms of penalties, leading to rising operational costs for these companies in India. India's foreign enterprises harvesting behavior is not accidental. It is a systematic policy. This harvesting is not random, but often targets companies with significant foreign exchange outflows. For instance, foreign enterprises transferring their profits out of India are often closely monitored by the Indian government. And regardless of whether such transfers comply with local laws, they face corresponding fines. If foreign companies choose to leave all their profits in India and avoid transferring funds out, they can maintain a better business environment. According to data from 2005 to 2025, fines imposed on foreign companies in India due to tax issues have exceeded $120 billion, while fines for other reasons have also accumulated to hundreds of billions of dollars, totaling about $186 billion. These fines are not limited to traditional foreign enterprises in India, but also involve multinational companies like Coca-Cola, Walmart, Vodafone, IBM, Google, General Motors, Ford, Nokia, Samsung, Volkswagen, and Chinese companies such as Xiaomi and BYD. Although India faces pressure from the international community, including strong protests from Western countries over its foreign exchange restrictions policy, India has still chosen to protect its foreign exchange in its own way. Not only does India impose fines on foreign companies due to tax issues, but it also modifies laws to circumvent foreign companies' profit transfers. Even some companies such as Samsung and IBM have been forced to adjust their strategies but have still not escaped India's strict policies. India's hidden foreign exchange restriction policy. Why is it not afraid of damaging the business environment? Although India's approach has sparked international controversy, the Indian government sees this method as necessary. By controlling the profit transfer of foreign enterprises, the Indian government can better tighten its foreign exchange flow and avoid further expanding its foreign debt. While these measures may impact the business environment to some extent, India does not seem concerned about losing the favor of foreign enterprises in the short term. The foreign exchange earnings that foreign enterprises can generate are crucial to India's economy, and the government cannot easily give up this source of wealth. First of all, India's business environment has long been less than ideal, especially in the eyes of Western countries, where India's reputation has already plummeted. Western companies have even coined the term tax terrorism to describe India's tax policies. Although the international community has a poor opinion of India's business environment, India does not mind these criticisms. After all, India has a huge population and market, and globally, most markets are already saturated. Apart from the less economically developed African markets, the remaining market is India. Expanding into new markets inevitably involves risk. But for India, these risks are strategically significant and beneficial to both the country and its data performance. As a result, many international giants, even facing unfavorable conditions, still choose to invest in India and set up their operations. Secondly, India has long honed a clever strategy. They do not directly sever the roots of foreign enterprises, but instead cleverly place them in a dilemma where they are unwilling to fully withdraw but must endure the harsh conditions of the Indian market. There is a saying among the people that India earns, India spends. Don't think you can take a single penny home. Even so, foreign enterprises can still make certain profits in India, and the money they earn is allowed to be spent locally in India or even taken in the form of rupees. However, if they want to exchange their profits for US dollars to take out of India, that becomes difficult. In the long run, foreign capital is just a crutch for India's short-term economic development. India does not cherish foreign investments but instead kills the chicken to get the eggs, focusing only on short-term economic growth and ignoring the long-term costs behind it. Some believe that India is facing an unprecedented national crisis. With no clear way forward in military, economic, or diplomatic matters, India neither dares to go to war with Pakistan again, nor can it confront the U.S. head-on on tariff issues. What was once a strong foreign policy strategy has now been exposed to the world. At the same time, India's domestic political situation is exceptionally complex. The Congress Party is doing everything it can to undermine Modi, calling for his resignation and blaming all the problems on him. There is also mounting internal pressure, with repeated public statements that Modi should retire. As a result, Modi is facing enormous political pressure. However, as an old hand, Modi has already prepared a move. The nationwide caste census. This is an extremely sensitive and controversial action because the caste system has been regarded as a backward social system since India's independence, and the Indian constitution has long abolished the caste system. Therefore, caste information has not been included in any population census. This system goes against India's founding principles. However, Modi's purpose in pushing for this census is to strengthen his political legitimacy through data and further consolidate his political foundation. Given India's political and economic complexity, the dual-edged sword effect of foreign investment, and the controversy surrounding the caste census, all these factors are shaping the future of the country as investors. Understanding these dynamics is crucial to mastering the Indian market. If you have more thoughts on India's economic prospects and the challenges of foreign investment, feel free to share them in the comments section. Don't forget to like and subscribe for continuous analysis and commentary. Today, we will discuss the caste census issue in India and the political motivations behind it. Why is Modi's government pushing for the caste census at this time? What are the deeper political considerations behind it? But what impact could this census bring? What we're concerned about is that India's political environment might turn into a quota bidding system. With different political parties vying for votes from various caste groups to gain support, this kind of political manipulation could make India's elections more complex and further exacerbate societal divisions. In summary, although Modi's government's actions seem aimed at consolidating political power, they might lead India to face a greater issue of social fragmentation. In the long run, India's strongest suit may still lie in its performative foreign policy, especially in relationships with major powers like those in the Americas seeking more strategic space. Finally, the progress of the US-India negotiations also has a significant impact on the stock prices of tech companies like Nvidia. With increasing friction between the two countries in the high-tech sector, Nvidia, as a leader in the global semiconductor industry, is facing considerable challenges. First, there's the impact of the US-India negotiations. Any breakdown or uncertainty in the trade talks will directly affect Nvidia's sales and profits. Especially in the Chinese market, if the relationship between the two countries deteriorates, it could negatively impact Nvidia's global business and, in turn, drag down its stock price. Second, there's macroeconomic pressure. The growing uncertainty in the global economy is also increasing market volatility, rising U.S. inflation, changes in interest rates, and especially expectations of rate hikes by the Federal Reserve, could lead to capital outflows and increase the risk of a market correction. The turbulence in US-India negotiations further heightens the instability of global supply chains, fueling market panic. Although Nvidia's earnings report is strong, the stock's rapid rise has created an overly optimistic market outlook, which is often a precursor to a correction. The overly optimistic sentiment in the market, along with Nvidia's impressive earnings, has driven its stock price up too quickly in recent times. The market's expectations for the future have become overly optimistic, and such overconfidence can easily lead to a stock price bubble if market sentiment shifts. The bubble could burst, resulting in a significant pullback. There is also the possibility of panic selling if the stock breaks key support levels. The market may fall into panic, causing investors to quickly sell off their holdings, further exacerbating the decline. This emotional reaction acts as an accelerator for the market correction, potentially leading to a 15% pullback in Nvidia's stock price. Although Nvidia is a leader in the AI and semiconductor fields, the industry's competition is intensifying, and the challenges ahead should not be ignored. With increasing competitive pressure, as AI technology becomes more widespread, Nvidia faces strong competition from companies like AMD and Intel. While Nvidia currently holds a dominant market position, whether it can maintain this position in the future remains uncertain. If the market believes Nvidia may lose its competitive edge, the stock could face a pullback. The correction of market expectations, along with Nvidia's current high valuation, also puts it under considerable downward pressure. Even with strong earnings reports, the stock's overvaluation might prompt investors to adjust their expectations. If the market revises its high growth expectations for Nvidia, the stock price could face substantial adjustment space. The stock market typically experiences a pullback period after a period of upward movement. Especially when the bubble in tech stocks begins to emerge, Nvidia's current stock price is already at a high level, and a cyclical market correction is inevitable. After a period of market rise, there's often a correction phase, particularly when technical indicators and investor sentiment change. This cyclical fluctuation is part of the stock market, and as a tech stock, Nvidia faces a particularly noticeable risk of a pullback. A 15% correction would be within the normal range. The impact of a broader market correction, if the overall market, such as the Nasdaq index, adjusts, tech stocks like Nvidia tend to be affected. A broader market correction often leads to a larger pullback for individual stocks, and Nvidia is no exception. From multiple aspects, including technical indicators, macroeconomic factors, investor sentiment, and industry competition, Nvidia faces a certain risk of a pullback. Technical indicators such as a high RSI and stock prices nearing support levels, combined with the uncertainty of US-India negotiations and global economic pressures, are making market sentiment increasingly tense under these circumstances. A 15% pullback risk is not only possible, but may accelerate. Investors should always monitor these signals, adjust their investment strategies reasonably, avoid blindly following the crowd, and implement proper risk management. Alright, that's all for today's video. If you like our content, don't forget to subscribe, like, and comment. See you in the next video.